All right, Oaktree Capital Group co-chair Howard Marks really needs no introduction. More than 50 years of experience with a very unique and evolving assessment of what constitutes value. His periodic memos, must-reads. And his latest, it focuses on two major sea changes that he navigated in his career, and a third sea change underway right now that has taken us from a low-return world to what he says is a full-return world that should provide much better opportunities for bargain hunters. Pleased to say Howard Marks joins us for an exclusive interview right now. Howard, great to see you.
Nice to see you, Romaine.
You talk about these sea changes, two big ones, of course, that really marked your career, a lot of it having to do with sort of a recalculation and I guess a reassessment of what risk is and whether you should embrace it. Of course, a low interest rate environment that dominated for basically 4, almost 5 decades. And now you say we're basically in the middle of a third sea change. What is it?
Well, if you look at the period from the end of the global financial crisis, roughly '09, through the appearance of the pandemic, and then in the 20 and 21, we were, the Fed took extreme measures to save the economy. They worked. Very low interest rates, the lowest in history, 0 for much of that time, and quantitative easing, the buying of bonds, which puts liquidity into the economy. These things produced what I would call was an easy environment in the economy and the markets. We had the longest economic recovery in history. It was easy to make money.
Right.
We had low-cost capital. It was easy to make a profit. We had very few defaults and bankruptcy. It was easy to stay in business. It was easy to access capital. Everything was easy at that time. And in the last year, of course, with the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder. I imagine people today saying, well, when are we going back to normal, like it was 5, 6, 7 years ago? And the important thing to know is that that wasn't normal.
Right.
That was the easiest, the best of times.
Right.
And my own belief is we're not going back there. We're now in an environment of more normal circumstances, and we're going to roughly stay this way.
Well, do we go back? I mean, what do we go back to at all? Because when I sort of read that memo and I look at sea changes, it sounds like everything new is new. It's never really a reversion to where we were in the past.
Right. Well, that's what a sea change is. It's a complete transformation, not just a minor cyclical fluctuation. So, look, I think that the business world, the economic world, is not supposed to be easy. It's not supposed to be easy to make money.
Right.
Or, it's not supposed to be easy for companies with bad business models to stay in business, as it has been for the last 14 years.
Right.
So I think we go back to a period in which we have moderate interest rates, we have moderate availability of capital, we have a moderate default rate, and so forth, all of which will feel much less accommodative, I think, than the last 14 years.
But so much of the agita in the market right now is, of course, people trying to figure out what that new rate is,
right.
or if you want to call it a neutral rate or whatever. But, I mean, when was the last time that you could remember that we had a stable and persistent neutral rate?
Well, it depends on your definition of stable time-wise, but of course, I think that the Fed became activist with the arrival of Alan Greenspan in the mid-'90s, and I think that we had, people started to talk about the arrival of the Greenspan put, that if there was a problem in the economy, the Fed would just squirt in some liquidity and solve it, and
they frequently did.
And they frequently did, including Y2K and other real and imaginary crises, the arrival of the bursting of the TMT bubble, for example. So I would say that that's 25 years that we haven't had what I call a free market in money.
But what gives you conviction that Jay Powell and whoever his successor might end up being are going to sort of move in a different direction, where they're not going to necessarily kowtow to the market in a way that the market has come to expect?
I'm applying common sense. You can't always count on common sense, but the events of recent years tell me that it's not great to have interest rates at 0. Zero interest rates are really an emergency measure. Somebody gets a heart attack, you give them a shot of adrenaline. Works.
Right.
That doesn't mean you start your day with a shot of adrenaline every day for 7 years.
Right.
We had rates at 0 for 7 years, and I think that And by the way, by the time 16, 17, 18 rolled around, people started to say, well, shouldn't rates be a little higher so that if we have a recession, the Fed can cut rates and become accommodative? Well, if rates are 0 or a quarter or a half, you can't do that.
Yeah.
So I think that's an important reason why rates should be positive. And if you want to fight inflation and kill off inflationary psychology, which is very important, you need a positive real Fed funds rate.
Right.
That is, the Fed funds rate has to exceed the rate of inflation.
And we
have a way to go before that's the case.
Well, is there any historical precedent that you sort of look to that maybe, if not a parallel, at least maybe gives you a little guidance?
Not really, because Mark Twain said, history does not repeat, but it rhymes. We haven't had much experience with inflation. I lived through the last one, which was in the 70s, a most unpleasant decade.
Right.
But then I think the situation was different. The sources of the inflation were different, and of course it reached the mid-teens.
Right.
I think we're not going there this time. I think that the original reasons for the current bout of inflation, too much money chasing too few goods, money from pandemic relief, money people put in the bank in 20 because they couldn't spend it, and then a supply mechanism that was sputtering, too much money chasing too few goods. That will correct over time.
Okay.
The extra money will get spent, supply will catch up. I think the forces behind inflation will abate.
Okay, so that puts us in a situation where the risk profile is going to be a lot different. I mean, you started your career at a time when risk was a much different thing, at least relative to what we saw over the last 15 years or so here. So what does that mean for the next generation of investors? What are they facing when it comes to how they have to assess that risk?
Well, anybody who joined after 2009 pretty much only saw good times, except for a couple of bad months in 2020 in connection with the pandemic shutdown. But, for my first 30 years in high-yield bonds, 78 to 08, the average default rate was about 4% a year. In the last decade, it was only 2% a year. I think 4 is more normal. And, defaults and bankruptcies should not be that scarce. And I think we'll be going back to a somewhat harsher environment.
Well, let's unpack that. I mean, start off first with the rally that we've been seeing lately in high-yield debt. What do you make of that? Do you see it as sustainable, persistent?
Well, I think the current prices are roughly sustainable. When you say, is the rally sustainable, they're not going to keep going up. That is to say, yields are not going to keep coming down, in my opinion. I think that rates are roughly where they can stay, except that I think it's important to recognize that the debate today is being dominated by people who are optimistic, by people who think that the recession won't be too bad, won't be too long, that the inflation will give way, and that the Fed will be able to turn accommodative soonish.
Are you optimistic?
Not on that subject. I mean, I think that the Fed is going to want to be somewhat strict and hold that position, well, let's say throughout the year.
Okay.
I don't think the Fed wants to be seen as being optimistic, hawkish, dovish, dovish. They want to have some constancy.
Okay, so then what's the temperature out there right now in the markets? I mean, when you are sort of looking at where we stand right now, more importantly for investment opportunities, what is the temperature that you're seeing?
I think that in many areas in the stock market, for example, that a significant degree of optimism is ruling the day today.
Okay.
And if you want to look at pessimism, look at June, look at September. Then people were not so optimistic about this pivot towards dovishness. So, and we've been going back and forth, and the S&P, for example, has been trading in a channel between 3,700 and 4,000. Yep. Depending on whether the optimists or the pessimists were in the ascendancy. Right now, I think the optimists are in the ascendancy. Who knows how the events will bear them out.
So when you look for opportunities, this is an environment, whether it's you or the folks over at Oaktree, I mean, what are you looking for right now? Are there specific areas that you think might end up being more attractive, or is this just kind of, pick your battles one by one?
Well, we do it one by one. We're what's called bottom-up investors. We're not strategic. We don't say we want to have so much in America and so much in Europe and so much in steel and so much in paper. And let's find some companies. We just look for pieces of paper that look reasonable from companies that we think will stay in business.
What gives you confidence, though, in some of those companies now, particularly if the easy money is era? So if you're talking about a company that's in distress levels or near distress levels, what gives you that confidence that that ends up paying off?
I would say value. If we as creditors can buy the debt of a company that we think can stay in business because it has a good business model and some margin for error in tough times, and if we can buy the debt at a place in the capital structure where we create ownership in that company potentially at a reasonable valuation, that's what we look for.
You mentioned the word value, and you came up at a time where you, and to a certain extent, kind of redefined for the broader market what value is, what risk is, not just you, but of course Milken and a few others out there, and I don't know what was in the water in LA back in the 70s and 80s, but it seems like everyone who ended up making their fortunes in the distressed area all seems to be concentrated out there. Well, I mean, what was it that you saw back then that sort of gave you that idea?
Well, what we saw really was this sea change, Romaine. Prior to 77, which I think, or 78, which was the advent of high-yield bonds, a bond rated below investment grade could not be issued.
Yeah.
Moody's defined a B-rated bond as follows: fails to possess the characteristics of a desirable investment. In other words, bad idea. After Milken and others arrived in 77, 78, the new way of thinking was, well, it's not a great company, but the promised rate of interest is enough to compensate for the risk. And for the last 45 years, and I think for the rest of time, we don't think of good idea, bad idea. We think risk return, risk return. Is it, how risky is it? Is the promised return adequate to compensate for the risk? And that's very important. So the point is that the people who started to do this early,
right.
I was lucky to be asked to form a high-yield bond fund by Citibank in 78.
Yeah.
The people who started doing it earlier could find places that people were saying, oh, no, we wouldn't touch that, that's low grade.
Yeah.
And where you could get a high return without taking much risk. That was kind of a free lunch.
Yeah.
Efficient markets tend to cause free lunches to go away.
Yeah.
But it was great to get there early.